Numerous novice investors do not comprehend what a dividend is in relation to an investment, especially for individual stocks and mutual funds. Typically issued by a publicly traded company, a dividend distributes a portion of a company's profit to eligible stockholders. Typically, monthly, quarterly, or annual financial distributions are made to shareholders in the form of dividends. However, not every business pays dividends. Typically, the board of directors decides whether or not a dividend is desirable for a company based on various financial and economic factors. Dividend basics. Before receiving a dividend payment or distribution, shareholders of a particular stock must satisfy certain requirements. To be eligible for the dividend payment, you must be a shareholder of record on or after a specific date designated by the board of directors. Sometimes stocks are referred to as trading ex-dividend, which simply means that they are trading without dividend eligibility on that particular day. You will not receive the most recent dividend payment if you purchase and sell shares on their ex-dividend date. Now that you have a fundamental understanding of a dividend and its distribution, let's focus on what you need to know in greater depth before making an investment decision. What is the dividend yield? It may seem counterintuitive, but a stock's dividend yield decreases as its price rises. A stock's dividend yield indicates how much cash flow you receive for each dollar invested. Novice investors might mistakenly believe that a higher stock price corresponds to a greater dividend yield. To comprehend this inverse relationship, let's examine how dividend yield is computed. Typically, dividends are paid on a per-share basis. If you own 100 shares of ABC Company, those 100 shares serve as the premise for your dividend distribution. Consider that ABC Corporation was acquired for $100 per share, for a total investment of $10,000. The board of directors agrees to pay an annual cash dividend of $10 per share to the ABC Corporation's shareholders in light of the company's unusually high profits. As a result of being an owner of ABC Corporation for 1 year, your continuous investment in ABC Corporation results in dividends of $1,000. The annual yield equals 10% when the total dividend amount, $1,000, is divided by the stock price, $10,000. If 100 shares of ABC Corporation were purchased at $200 per share, the yield would decrease to 5%, as 100 shares now cost $20,000, or your original $10,000 would only purchase 50 shares. As demonstrated previously, if the stock price rises, the dividend yield falls, and vice versa. A quick reminder, if you've enjoyed the video so far, consider subscribing, as we frequently upload informative and educational videos. Let's continue. Assessing dividend-paying stocks. The real question is whether dividend-paying stocks are a sound investment in general. Since dividends are derived from a company's profits, it is reasonable to presume that dividends generally indicate a company's financial health. From the investment strategy standpoint, purchasing established companies with a history of excellent dividends provides portfolio stability. If you invest $10,000 in ABC Corporation and hold it for 1 year, it will be worth $11,000, assuming the stock price remains unchanged. In addition, if ABC Corporation stock is trading at $90 per share 1 year after you purchased it for $100 per share, your total investment is still even after dividends. $9,000 stock value plus $1,000 in dividends. This is the appeal of purchasing dividend-paying stocks. It helps mitigate declines in actual stock prices while presenting the opportunity for stock price appreciation and a constant stream of dividend income. This is why numerous investing legends, such as John Bogle and Benjamin Graham, advocate purchasing dividend-paying equities as a crucial component of an asset's investment return. The risks to dividends. During the 2008 to 2009 financial crisis, nearly all prominent banks reduced or eliminated their dividend payments. These businesses were renowned for their consistent, stable quarterly dividend payments for hundreds of years. Despite their lengthy histories, numerous dividends were eliminated. Another potential disadvantage of investing in dividend-paying equities is that dividend-paying companies are typically not high-growth leaders. There are a few exceptions, but high-growth companies usually do not pay their shareholders substantial dividends, even if they have outperformed most stocks over time. In other words, dividends are not assured and are susceptible to macroeconomic and company-specific risks. Research and development, capital expansion, retaining exceptional employees, and/or mergers and acquisitions are ordinary expenditures for growth companies. For these corporations, all profits are deemed retained earnings and are reinvested in the business rather than distributed as dividends. Equally essential is to avoid companies with exceptionally high yields. As we have seen, a company's yield increases if its stock price declines. Numerous novice investors are enticed to purchase a stock solely on the premise of a potentially lucrative dividend. There is no specific rule of thumb regarding the amount of excessive dividend payout. Historically, the average dividend yield on dividend-paying S&P 500 companies fluctuates between 2% and 5%, depending on market conditions. In general, it is beneficial to research stocks yielding more than 8% to determine the company's true state. Do not rely on the dividend percentage to determine the overall health of a company. It is important to perform your due diligence to distinguish between companies genuinely in financial ruin and those temporarily out of favor and thus offer a good investment value proposition. Key takeaways of dividend investing. Dividends are profit distributions made at the discretion of a company's board of directors to its current shareholders. A dividend is typically a cash payment to investors at least annually and sometimes quarterly. Dividend-paying stocks and mutual funds are usually on solid financial ground, but not always. There is an inverse relationship between stock price and dividend yield, and the distribution may not be sustainable if the yield is excessively high. Dividend-paying stocks typically provide portfolio stability, but do not typically outperform high-quality growth equities. If you enjoyed watching this video, please like and share the video with anyone else you think could benefit from this content. Don't forget to hit that red subscribe button so you don't miss any of our upcoming exciting topics. Till then, goodbye and see you in the next video.